Hello, everyone. My name is John Locke, and I'd like to welcome you to The Winning Trade. But first, the required disclaimer material. This presentation is given for educational purposes only. We're not broker dealers or financial advisors, and I'm not making any specific trade recommendations. Also, please be aware that your risk in trading options is substantial. Please make sure you're aware of all your risks prior to placing any trades. Also note that in this presentation, we are covering hypothetical computer simulated trades and the results. They're believed to be as accurately represented as possible. Keep in mind that live results can vary from simulated results for many different reasons. My name is John Locke. I'm a trading performance and financial freedom coach with Locke in Your Success LLC. And to get to our website, just simply go to lockeinyoursuccess.com. And myself and my team of mentors are here to help you win in the markets and in life as well. And what I want to do today is I want to take you into the realm of high probability options trading. Now, high probability trading is where we utilize option strategies to make money from the passage of time rather than depending solely on price movement in order to be profitable. Now, this doesn't mean we're going to make money all the time, but we can often be profitable whether the market goes up, down, or sideways. Now, within our community, we cover a lot of different types of high probability options strategies. The one I'd like to discuss with you today or present to you today is called the M3. Now, the M3 is a time-tested and proven strategy. It has a long history of success in the live markets. Many of the students that I have live traded this strategy since 2007 through all types of different market conditions and continue to trade it today. And not only is the M3 a fantastic base strategy, many people, including myself, have utilized the techniques and concepts within the M3 along their path to becoming consistently profitable traders, even if they've shifted into some other strategy since then. So let's move forward, and I'll show you an example of the M3 strategy. So when we talk about the M3 strategy, this is a strategy that we trade on the Russell 2000 index options. The strategy itself, if you were to trade at its minimum size, is going to require a minimum capital of $5,000 per trade. And this is what we call a planned capital, or the maximum amount we would expect in the position at any time. The example size we're going to show you today is a $50,000 planned capital position. It has a profit target of 10%, or in this example is going to be $5,000. It has an exit loss trigger where we'd like to get out of the trade should things go poorly of $5,000. The strategy is entered 56 days to expiration, and it could go all the way to expiration if we do not hit our profit target or an exit loss trigger. So without further ado, let's take a look at what the legendary M3 looks like. And here we have a software called OptionNet Explorer. What this software does is it gives you an analytical graph of the risk profile within your position. So that's what this is here. We have an asset price along the bottom. We have a dark blue line here that's shaped like a triangle, and that is what we would call our expiration line, which represents the value of the position should we hold it to expiration. This represents the settlement value of the position if we hold it that long. We also have this curved line called a T+0 line, and that represents the value of the position at any given price point of the Russell 2000 as of today. As you can see, the software is estimating if we get a very large up move, really no change, really large down move, really no change. How do we make money? Well, we make money through the passage of time and shifts in what we call implied volatility. Over time, what tends to happen is this T+0 line is going to take the shape of our expiration line, and we will gain value in here and lose value out here. Now, should the market move around, we would do something called adjustments to the strategy to keep ourselves within a range where we can be profitable. So this is what the position looks like. If we look at the software here, it is June 24th, 2022. So this software is really cool. It allows us to go back in time, which we do here. Great for examples, good for back testing as well. The asset price of the Russell, 1757. We have what we call our delta, which is the risk in or the profit and loss that we can expect with a $1 price movement in the Russell. So we're slightly positive delta in this case. We have our theta, which is theoretically how much money this gains or loses in a day. We have vega, which is theoretically how much this gains or loses with 1 point of implied volatility change in the marketplace. I say theoretically because everything depends on implied volatility. and implied volatility is not a static factor, it's an emotional factor in the marketplace. So our T+0 line, as you'll see, can vary quite a bit from what it projects. But those are the base Greeks with the position. That's what they mean. Current profit and loss after entry is $81. Our position here, if we look over here, we have our options cycles. So we are, again, June 24th. We're going to enter the August 19th, 2022 expiration cycle. It's 56 days to expiration. We have our call options here, and these are the strikes. We have our put options. These are the strikes. We're going to come in and we're going to do an iron butterfly order. And I'm going to have our short strikes about 17 to 27 points under the money. So we're at 1757. That puts our short strikes at 1740. We're going to do 20-point wings. We're going to start with modeling a 10 lot to see what our delta is. If our delta is very low on a 10 lot, we'll jump it to a 20 lot if we can do that. In this case, we can. So we're going to do 20 butterflies. When we do 20 butterflies, and that's our maximum size for $50,000 planned capital position. When we do 20 butterflies, we notice our delta is minus 23.32. So I'm going to come in here and buy, and in this case, a 25 delta call. It happens to put a slightly positive delta. And this is going to be our entry position. That's what this graph represents. And as things go along, essentially what's going to happen is we have delta limits of plus 50, minus 15. If we hit those, we are going to make what we call an adjustment to flatten that out. If we get too far under the money here, we're going to roll back. We get too far over the money, we're going to roll forward. I'll show you as things go along. We also have a capital or a drawdown limitation with an 8% move in the marketplace. So in other words, if the asset price moves down 8%, so you would multiply 1757 times 0.92 to get that number. If it draws down more than $10,000 with that type of a move, then we're going to have to make corrections for that. And I believe pretty much all of that's covered in this example. So it's a great example. So here we are, Friday, June 24th. This is what our position looks like. I'm just going to jump into a first adjustment here. And quite a bit of time's gone by. So basically we've sat in this position. Looks like this is something called a T-log here. We entered at 624. We did nothing till 715. So we sat in this thing for almost a month. And the price move has been pretty much sideways, which is ideally what we'd like. Although that hasn't happened very often in the market lately. Ideally, that's our ideal situation, right? If I'm directional, I'm not making any money here. The market's not going anywhere. I can make money here, which is really cool. And if the market moves outside range, we just readjust our position. So here, what's happening is we've gone all the way till Friday, July 15th. And at this point, our delta number's gotten to minus 19.64. Our limit in this position is negative 15. So I need to make a correction. I'm right in the middle of 10, so that's not an issue. But like I said, we watch this number and try and keep it relatively flat. So what we're going to do here is we're going to take this call that's currently 12 delta, and we're going to sell it, and we're just going to move it deeper in the money. And we ended up moving that call to down here at 1810. And when we do that, that corrects our delta. And in this case here, we're pretty much neutral at 12. So this is our new position. Okay, I'm going to jump forward here again to our next adjustment. So it's July 15th. 5 days later, what ends up happening here is all of a sudden the market takes off. So we're in a position here where the market was relatively sideways for a while, and that allowed us to sit in our position and gain profit, which was great. And now all of a sudden the market goes. So now it's outside of our range. So that being the case, what we're going to do is we're going to do what we call a roll. We're going to close out this butterfly here, and we're going to move it forward. And basically what we're going to do is we're going to go back to entry position. So if you take a look at what we did, we just shut this position down. We rolled up to short strikes of 1810. We still have our 50-point wings. We repositioned our call. And here we are back in this position, relatively neutral delta, inside of the tent once again. Okay, so July 20th, let's jump ahead to July 28th. What happens here is the market's really taken off. So we end up coming here and the market shoots up to 1871. This again puts us outside of our range. Now we do allow this to go outside the tent, but only a certain amount. This is too far. So what we're going to do is we're going to, again, close this position and go into what we call entry position. So I'm going to close that out. And again, entry position is about 20 points under the money here. So 1871 puts our short strikes at 1850. We still have our 20-point wings. Now, as we're getting closer to expiration, what's happening is it's getting more expensive to be in this position. And as we get closer to expiration, we start taking on some downside risk here. In other words, this T+0 line isn't so flat anymore. And we want to watch the profile of that. If that gets too high, and that's, again, more than 10,000 with an 8% move, we are going to make adjustments for that as well, which we will be doing later in the trade. So here is our current positioning, July 28th. Let's jump to next adjustment, which is August 1. What ends up happening here, our maximum negative delta is -15. We are more than -15. Looks like we are at 73 delta. We could probably correct that with a call move. Let's see what we did here. We did that. So what we did is we went from our 73 delta call to a deeper in the money call. Of course, you can only go so far. At some point, you get into the 90 delta range, and really it doesn't have an effect to go deeper in the money. So, but in this case here, we can come down to about 86 delta. We really can't go a whole lot further than that, or it won't really make much of an impact. But we brought this down here, and that corrected our delta violation. So let's move to next adjustment. All right, so here we are. Market continues up. If we look at our price chart, we were down here, and we really took off to the upside. And this is where we sit. At this point, we're over our maximum negative delta. We are also over a point at which we should roll the position. So this is going to require a roll up. And to be more precise, if we're more than 10 points over our long strike, generally we're going to roll this forward. So we are more than 10 points over our long strike, so we're going to roll it forward. This time when we roll it forward, though, as I was saying, we're getting more and more downside risk when we roll up. We're getting more and more expensive in the butterfly as we get closer to expiration. And that being the case, if I rolled up and went into or repositioned to start position and I went with 20 lots, I had too much downside risk. So that being the case, we're going to cut our position down to what we call a standard size, which is a 10 lot. So I'm going to roll I'm going to do the same thing, right? We're at 1910. I'm going to go to 1890 with my short strikes, and I'm going to do all this analysis to see how much my drawdown is with that position size. But in this case here, if I do the 20 lots, I have too much downside risk based on my downside parameters. That being the case, we're cutting to 10 butterflies. We'll relocate our call. We'll re-enter into entry position. And this is going to be our position. And if we go to next adjustment, you can see we're doing things more frequently now because the market's moving a lot and we're getting close to expiration. So that combination will do that for us. If we go here, we are at -24 delta. Again, first thing I'm going to look at, if I'm inside my tent more or less and I have a delta issue, a negative delta issue, the first thing I'm going to look at is, can I drive the call deeper in the money? And yes, I can. If I can do that, then I have to look at, well, what consequences of downside risk does that have? If it's within reason, that's what we're gonna do. So in this case here, I can bring this call deeper in the money. I brought it from about 1910, I think it was, to 1870. That takes care of our delta violation. We're 14 days to expiration, and this is our new positioning. We go to next adjustment, which is the 10th. Let's describe what happens here. So again, look at this up move we're getting. This is not non-directional. Okay, we've had quite a breakout and quite an impressive up move here in the Russell. So we are past our point again. Of course, we're getting really close to expiration. We can always exit, but we do have guidelines to bring this trade right into expiration. So I'm just going to talk about them. So I'm going to come in here, and what I'm going to do is I'm going to do the same thing. So we're at 1968. I'm going to come up to short strikes of 1950 is what it's going to be. So I'm going to sell this position out. I'm going to go to what would be this position here. And I'm just kind of model what entry position looks like. Okay, if I did a standard butterfly, if you look in the green, this is the green. Look at the model. When I come in here, I have 94 delta on my butterfly when I try to reposition it to entry position. And if I do a 94 delta call, we look like this. If we take a look at our downside risk here, we have $25,000 structural risk in the position approximately. And if I do my 8% down move, which I'm not going to do the math here, but if I do that math, I end up with a drawdown of more than $10,000. So that's a risk violation, structural risk violation within the position. So what we're going to do to fix that is going to roll up this 1900. And in this case, it's going to, and I might experiment with different levels, but in this case here, it takes us to 1920. And when I do that, I'm also going to roll my shorts up the same 20 points. And I'm going to end up in this position here. And missing out something here. I'm going to end up in this position here. And then that's going to give me 43 negative delta. So I'm going to add the call to bring that flat. And that's how we get here. So this is going to be our new position after adjustment. And this meets our downside risk requirement. It's within our delta limits, and it's within the tent limits. Okay. If we go to, we'll take this a couple days at a time here, or one day at a time. That's what happens next day, not an issue. And we are going to tend to get more active here. All right, so what ends up happening here is we have a violation. We run outside the tent. And we also have a maximum delta violation. This is actually going to call for a roll up. So I'm going to roll the position up. I'm going to do the same process, right? I'm at 2013. That's going to put my short strikes, my initial short strikes at 1990. Initial short strikes at 1990, and then I'm going to do this process of moving my shorts and my longs to get the right downside risk and move my call as needed. If I do that, this is the position I end up in. And I did this just for demonstration purposes. This would be my initial rolled up position. I have 133 minus delta. I'd have to move my short strikes here to correct my delta. Then I'd have to add the call in. When I do that, I have too much downside risk. I have to do the process of rolling these up and rolling these up to get within my risk limits and then putting a call on. And if I do that, we end up with 20-point wings here. So I have to roll all the way up to 1970 to do that. And I also keep my 20-point wing up here. I end up with about 38 or about 35 delta, so I can throw my call right in here. And this is my new rolled up position that meets all my requirements for being in the position. And then if we go to the following day here, what ends up happening is the market moves up a little bit. I violate my negative delta guidelines. I'm able to move the call deeper in the money, so I do that. I'm still within risk tolerance. I don't even have 10,000 in the trade, so that's not going to be an issue unless I have some sort of a delta limit at this point. So that is our new positioning there. If I go to the following day, what ends up happening is I have another delta risk violation here. So what I do is I end up moving my short strikes up. I also have to move these up to deal with my risk parameters to the downside. So now I only have about 3,000 in the position. This is what we look like. We're up $2,900. Again, that meets all requirements. So I had to make a bit of a move there. And then we go 2 days to expiration here. We end up getting a 30-point down move, which is very large. That puts us in a downside delta violation, and it also puts us below the short strikes, I believe. It does. That's going to require a rollback. So what we're going to do here is we're going to, and again, whether you're going to do this or not, this close to expiration is up to you, and I'm mainly showing you this for the process. If the market goes well here, by the way, in other words, the market has not been accommodating to us, but if the market's accommodating to us in this time period, we can pull off profit target fairly easily. But it's been wiggling around quite a bit with the constant movement, and hasn't allowed us to do that. And that sometimes that happens too. But we're going to have to roll this back. If we roll this back, we do the same thing. We put our short strikes at, let's see, we're about 1990, so we're going to put them at about 1970. We're going to do this process of eliminating our downside risk, and we're going to shorten our wings. In this case, we have to shorten all the way to 1960. So we're here with 10-point wings to the downside, and we have 10-point wings on the upside. We're in this little mini condor. We have our call at 15 delta, so our delta is relatively flat. And then we go into final day of trading. So let me jump into that. And we end up getting a 15-point up move. And with that 15-point up move, when it comes time to exit, now sometimes I will expire these, but I wouldn't expire a position like this. We just don't have enough room. But we end up with 39.51 for profit and loss here on this day, and we got to close it down towards the end of the day. And if I close the position down, that leaves us a profit of $3,910, or approximately a return of 7.8% on our planned capital. And if you look at the total capital that was ever in the trade, the total or the highest capital number in this was about $28,000. And that's going to give us a return of approximately 14.6% on our actual capital. A fantastic trade through a challenging market environment for the M3, this episode's winning trade. If you like what you see, and who wouldn't, I invite you to come on over to lockeinyoursuccess.com. That's LOCKE-inyoursuccess.com, or thewinningtrade.com. That's thewinningtrade.com, and discover how you too can follow along with this and many other great option strategies as they unfold during our weekly options trading for income webinars, where we review 12 different, very powerful, very effective trading strategies. Also, if you go to thewinningtrade.com, you can learn about upcoming winning trade presentation. You can receive access to free bonus material. And perhaps best of all, you can check out our free trading performance podcast, where you can learn to skyrocket your trading results regardless of the type of trading you do. If you have any questions, comments, or anything else you'd like to see on the next winning trade, please feel free to comment in the video below. I'll make sure I answer your questions for you personally. Thank you for joining me, and I look forward to seeing you on the next winning trade.